Welcome to The Explainer. Today, we're jumping into a real economic puzzle that's been all over the headlines. How can India's economy be on fire while its currency seems to be, well, struggling? Let's get into it.
So yeah, this is the big question, right? It's a paradox that has a lot of people, including some pretty smart economists, scratching their heads. You've got this powerhouse economy putting up some incredible growth numbers. But then you look at the currency, the rupee, and it seems to be losing its footing against the dollar. So how is this possible? How can an economy be firing on all cylinders while its currency is, running on fumes? Let's dig in and find out.
And wow, this really puts it in black and white, doesn't it? On the one hand, you've got the economy just soaring, an incredible 8.2% GDP growth, which, by the way, blew past most expectations. But then, on the other hand, just a few months later, the rupee hits a historic low against the US dollar. It's the perfect picture of strong fundamentals clashing with weak market performance. So what in the world is going on here? Let's start unpacking the forces that are pulling the rupee in two different directions.
All right, first up, the trade imbalance. This is really a tale of imports and exports. And to understand what's happening with the rupee, you have to start with this simple but massive imbalance between what India buys from the world versus what it sells.
Okay, just look at that number for a second. $42 billion. That's how much more India spent on imports than it earned from exports in a single month. That is a record. You can think of it like this. To pay for all those imported goods, businesses in India need US dollars, so they sell their rupees to buy those dollars. When you have a massive amount of rupees flooding the market, all chasing after dollars, what happens? Basic supply and demand, right? The value of the rupee goes down.
So what's driving this huge gap? Well, it's really a perfect storm of factors. For starters, back home in India, demand is strong, especially for things like gold during festival season. That's a huge import. Then, on the export side of things, Indian goods got hit with a steep 50% tariff by the US, which really hurts sales. And then, you just layer on top of all that a general sense of nervousness in global markets about a potential US-India trade deal. It all adds up.
Okay, but here's where the story takes a really interesting twist. The textbook economic theory says that a weak currency should be great for exports. It's simple, right? Your stuff becomes cheaper for other countries to buy. But, and this is a big but, a recent study from India's Exim Bank found that in India's case, that's not necessarily true. In fact, it can be the opposite.
So why's that? Well, it turns out that over half of India's exports come from industries that are super dependent on, you guessed it, imports. Think about it. To build the very products India sells to the world, things like electronics or chemicals, they first have to buy a ton of raw materials and parts from other countries. And when the rupee is weak, the cost of all those imported parts goes up. That can completely wipe out any price advantage you thought you had. It's a real catch-22.
So that's the story on the trade front. But it's not just about physical goods crossing borders. There's another huge piece to this puzzle, the global money trail. We're talking about the flow of capital, and this stuff moves fast.
And a huge part of that is something called foreign portfolio investment, or FPI. The easiest way to think about this is as hot money. It's cash from international investors that's looking for a quick return by buying up assets like stocks and bonds. And because it's hot, it can flow into a country and flow right back out in the blink of an eye, all depending on market moods. And lately, well, that hot money has been flowing out. We're talking about a net withdrawal of $17 billion from Indian stocks this year alone. And the mechanics here are the same as with trade. When those investors sell their Indian stocks, they get paid in rupees. But they don't want rupees, they want their dollars back. So they sell the rupees, buy dollars, and boom, another huge wave of selling pressure on the rupee.
And you can really see this relationship play out over time. This data from a BIMTech study basically shows a clear pattern. When that foreign investment, that FPI, is flowing in, the rupee tends to get stronger. But as we've just seen, that flow has recently reversed course, putting a ton of downward pressure on the currency.
So you've got this trade deficit, you've got capital flowing out, and all of this puts India's central bank, the RBI, in a really, really tough spot. It's a high-stakes balancing act for sure.
And this leads to something experts call the liquidity paradox. It works like this. When the rupee is falling, the RBI has to step in to defend it. How? By selling its own US dollars. But here's the catch. For every dollar it sells, it has to pull the equivalent amount of rupees out of India's own banking system. And what that does is it basically sucks money or liquidity out of the domestic economy. This can make it harder for businesses to get loans, and it risks slowing down the very economic growth everyone is so proud of.
And we are not talking about small change here.
The scale of this is absolutely massive. We're looking at an estimated 2.4 trillion rupees, yeah, that's trillion with a T, that the RBI has had to pull out of the system. That is a staggering amount of liquidity to remove from an economy, all in the name of stabilizing the currency.
And if all that wasn't enough, there's another headwind: interest rates. For a long time, global investors could get a much better return by putting their money in India compared to the US. But that gap, that premium, has shrunk by more than half. So now, with US assets looking safer and offering a pretty good return, it just gives that global hot money one more reason to pack its bags and leave emerging markets like India.
Okay, so far this whole story sounds pretty negative, I get it. But that's only one side of the coin. It's only looking at the immediate pressures. Because over the last decade, India has been quietly building a formidable financial shield, one that makes it way more resilient than it's ever been before.
I mean, just think back to 2013, during the taper tantrum, when India was considered one of the fragile 5 economies. Back then, a key vulnerability, the current account deficit, was at a really dangerous 6.8% of GDP. And today, it's down to a tiny, super manageable 0.7%. That's not just a small change, that is a massive structural improvement.
And then there's this. The country's war chest, its stash of foreign currency reserves, has more than doubled since that time. We're talking about going from around $320 billion to nearly $700 billion. That gives the central bank a huge buffer, just a massive amount of firepower to fight off currency swings and absorb global shocks.
So what does all that strength look like in practice? Well, first off, those reserves are enough to cover about 11 months of imports. That's a huge safety cushion. Second, and this is so important, India is now attracting a lot more stable, long-term investment, what's called foreign direct investment, or FDI. This isn't hot money, this is sticky money, and it's enough to cover that entire trade gap we talked about. So India is way less dependent on the flighty stuff. You add in record amounts of money being sent home by Indians living abroad, plus a booming services export sector, and you just have a much stronger foundation today.
So where does this leave the rupee? What's next? Well, honestly, it's a genuine tug-of-war between these two massive forces. And here's what that tug-of-war looks like. On one side of the rope, you've got all those downward pressures we talked about. The big trade deficit, the hot money heading out, the squeeze from the central bank, all of it pulling the rupee down. But on the other side, pulling back just as hard are those deep underlying strengths, the massive war chest of reserves, a much healthier current account, and those strong, stable investment flows. So the rupee's future really depends on which side wins this fight. Is that financial shield India has built over the last decade strong enough to withstand the global storm? Or are we seeing the limits of what even a super fast-growing economy can do in a really turbulent world? That right there is the multi-trillion rupee question.